Hello and welcome to another video. The world of stock market is very complicated, so in this video let's try to simplify it as much as possible. Before we move on, let's first understand what stock market is. Stock market is a place where all companies come together to trade their stocks. And a stock is simply a piece of a company. So when you own a stock, you actually own a piece of a company. Like any other business, if your business makes money, you will take the profit. But in this case, since you own only a piece of the company, so you will get only a piece of the profit, and that's called dividend. So the more stocks you own, the more dividend you will be paid, and that's one way to make money in the stock market. But businesses usually try to expand, to grow bigger and bigger. And as they grow, the value of the company grows as well, and the stock price goes up. So if you buy the Apple stock, for example, for $20, then they release the new iPhone, it becomes successful, and the stock price jumps to $30, that means you have made a profit of $10. And that's the second way to make money with stocks. But that's also a way to lose money. If the stock price goes down, let's say to $15, then you are making a loss of $5. So the stock market is a little bit like gambling. You make money if you make the right prediction, except that stocks can be predicted based on their performance. Not always, of course, but usually. For instance, the company like Coca-Cola worth more than $70 billion, and its stock has been increasing for the last 30 years. Of course, it has its ups and downs, but overall, it was going up. So it's very unlikely that it's going to go down in the foreseeable future. However, if it's a technology company, then it becomes more unpredictable because the technology is changing very fast. Now let's take a look at the two types of investors out there. The first types are active investors. Since stocks jump up and down every single day, this type of investors try to predict which stocks will go up today. So they buy them and then sell them once they go up, usually on the same day or the next. But for that, you have to be very well financially educated and spend hours every single day analyzing the stocks to make the right prediction, which is what a lot of people can't. That's why there is the second type of investors. They put their money into stocks and let it grow for years, so that in the long run they make a fortune. You might be thinking, what if I invest all of my money into one single company and then it crashes? That can happen, of course. That's why the first rule of investment is to never put all of your eggs into one basket. In other words, diversify your investments. Never put all of your money into one single company. Instead, invest them into many different companies so that if one company goes down, you are not going to lose a lot of money. And the way to do that is to invest through investment funds, because investment funds usually invest in hundreds of different companies. So when you invest in one of them, you're actually investing into many different companies. So if one out of hundreds of companies crashes, that's not going to affect your investment significantly. The best funds are probably the ones that invest in S&P 500, which are the top 500 biggest companies in US, starting from Apple to Coca-Cola and so on. The average total return over the past 90 years for S&P 500 has been 10%, which is not really bad if you invest your money in a bank where you might be given less than 1%. Anyways, 10% isn't really a lot of money. That's why you have to follow the second rule of investment. Use the power of compounding. When Warren Buffett was asked, the greatest investor of our time, what's the secret of his success, he simply replied, "My wealth has came from combination of living in America, some lucky genes, and compound interest." Compound interest works if you don't withdraw your returns every year and invest it back. Let's say that you are in your 20s and you invest only $100 every month. By the time you retire, it will grow to almost $1 million. On the other side, if you had saved that into a bank deposit, it would be only $54,000. Can you see the difference? That's the power of compound interest. Now imagine if you invest $500 every month. That will grow to $5 million just with a 10% of returns. So the key is to start investing as early as possible. If you're in your 20s and you're watching this video, then start learning about investing more and more and start doing it as soon as possible. Some of you might say, I don't want to wait 30 years until I make $1 million. Well, it's not necessarily to wait for such a long time. You can withdraw your money at any moment, but the longer you keep it, the more it will grow. Stocks are way much more complicated than what I have explained in this little short video. So if you're serious about investing, then I highly suggest you to further study the subject before making any move. And of course, I will be posting more videos on different kind of investments in the future. So be sure to leave a comment on what you want to see next and check out my previous video on investing. Thanks guys for watching. If you guys enjoyed this video, then hit that notification bell to never miss another video and give this video a thumbs up, and I will see you guys in the next one.